Hey, everybody, welcome back to the Journey Podcast. I'm your host, Morgan Debaun, and today's episode, we are going to talk all about real estate. I have an awesome guest today, Brian Adamson. He is a man of faith, dedicated husband, loving father, and he has successfully completed over 100 fix and flip wholesale deals and owns over 100 commercial multifamily units. That's an incredible amount of scale. And most importantly, he also is a person who teaches other people how to do this and how to think about investing in real estate. My journey with real estate, if you guys follow me on Instagram, you know, has been relatively rocky. When I first started to think about, hey, I need to buy a house, it was hard for me to get a loan because I'm an entrepreneur. So my W-2 income didn't look that great. And banks didn't know how to deal with the cap table that I had, with the assets that I had, and my total net worth and my investments was huge, but my income was inconsistent. And so I had to actually eventually use a mortgage broker to help me articulate like, hey, I can pay for this house 2 times, 3 times over, but it didn't look like that necessarily on how they were managing my debt to income ratio. Because fun fact, this is a total digress, but bear with me, you guys. Fun fact, when they were evaluating my debt to income ratio, they were taking into consideration the debt that Blavity Inc. had because I own a significant stake of our company. And we had, I think at that time, 3 million plus in convertible notes, which are loans. And so it looked funky. It looked funky when you add $3 million of debt into my personal debt to income ratio. The math didn't math for them. So anyways, real estate has been something that I've been curious about, how we can all take better advantage of it as a passive income stream. You know, I have a lot of friends that do real estate, that do multifamily investments, that have investments overseas. And I have just been like very hesitant to add it into my own set of income. I have over 8 income streams right now. So I brought Brian on today so we can get into how to make these decisions about real estate, how to be thinking about, especially if you have a 9-to-5 where this maybe isn't your primary like way that you make money. This is a way for you to make supplemental income so you can live a wealthier life, you can spend more money and have more discretionary income, but it's not without cost. So Brian, welcome to the show today. Hey everyone, I'm Morgan Debaun, a passionate entrepreneur and life advisor. With the Journey Podcast, you'll discover that success isn't about the destination, it's about the journey. I'm sharing stories of amazing people who've taken control of their lives. Join me on my own journey to discover the secret sauce behind reaching success with permission from no one else. How you doing?
Thank you so much. Thank you so much for having me, Morgan. I'm doing
amazing. So first, let's start with your journey into real estate. How did you get started?
So I got started in 2006, right before the market contraction. It was my junior year in college. And a buddy of mine was flipping houses. I didn't know what any of that meant. He just told me, he was like, look, you know, these buyers, they have the loan, but they don't have the liquidity to close on the house. And so I became a de facto private lender, leveraging my refund checks in college to cover the down payment for those buyers. And after he flipped them the house, he gave me a return on my investment. So I had a very unique start. And then quickly I figured out, well, hold on, wait a minute. They buying these properties with stated income loans. I could state my income, right? So that's what I started doing my junior and senior year in college. So I bought several rental properties before I graduated college. And then, you know, uneducated, being opportunistic, never saw 08 coming. And so all those things I was upside down on: mortgages, short sales, deed in lieu of foreclosures, the whole gamut. But I wasn't jaded yet. I was so new that I'm like, this $148,000 house is 28 grand now. Like, let me go do more of that. So from 2008 to 10, I built a small portfolio, like 20 doors. I was 24, 25 at the time, bought them all cash. And then got to a point where that strategy didn't work anymore because the market wasn't as compressed. And I was illiquid. I started having problems with, you know, infrastructure issues and basement dig ups and roof replacements and all this stuff that I didn't have the CapEx for. And so I had to sell off majority of that portfolio in a down market because I didn't know how to raise capital. I didn't have any skill. Again, I was just being opportunistic in the marketplace. And that finally led me to mentorship some 8 years into this journey. And then from there, learned how to actually put asset protection in place and stop being a hustler and a landlord and actually being a business owner and learning all the nuance to actually investing in real estate. And then that's where I started to, you know, raise capital and started doing active income strategies like flipping and wholesaling. And then later got into commercial multifamily the last 3 years. So that's like the 18-year condensed version of what's been happening.
Yes, you are literally goals. I think the key part of what you said was, how do I go from landlord to business owner? I think that's the part that people are missing when it comes to real estate. Like, so that's my fear. I'm like, I have no interest in being a landlord. I don't even want you to know that I own this building. You know what I'm saying?
That
Like,
part.
I want this to be in some sort of LLC under an LLC somewhere else. And I'm curious, like, what were the things that you had to do mentally to make that shift from like, okay, this is a hustle. Like, I'm going to do everything myself. I'm going to take on a lot of the work and effort, to being like, okay, I'm going to operate this like a business owner.
Yeah. So I think I'm a unique specimen in the sense that everything that I didn't do early on was because of ignorance. It wasn't because of interest. It was ignorance over interest. My interest always would have been to delegate, not have any interface with the tenants and all the rest of it. I just didn't know that those liberties existed until I actually invested in myself and got the proper education to find out what was behind the magic door. Right. So once I was made privy that I didn't have to be, driving over there, collecting rent and arguing with tenants once I figured I didn't have to do all of that, I quickly pivoted and started outsourcing and finding people that were much more qualified to do those things to free me up so that I could focus on finding more deals, raising more capital. Like as an investor, those are your two highest and best uses in addition to managing the managers. But essentially, with 10 to 12 hours a week and with proper delegation, you can build a multiple 6-figure, 7-figure business in 12 months by having the right systems, processes, infrastructure, and the right team around you to do these tasks.
Listen, y'all, now y'all know why Brian's on the podcast, because he's working smarter, not harder. So let's get into it. How can we do this? Let's say, hypothetically speaking, I've got an extra $50K that I was deciding, should I put this in the stock market? The stock market's had a crazy run, particularly if you're invested in tech stocks, which I tend to over-index in. Or I could put this $50K and diversify my portfolio into real estate. Let's assume, I live in Tennessee. So, we're not talking crazy prices, Nashville proper. But if you go out, outside of Nashville, the prices are pretty reasonable. Like, what are the things that I should be thinking about?
Yeah. So let me ask you a question. Did you go to college?
I did.
Okay. So did I. What's so interesting to me is that at some point in our lives, we thought that going to college would put us in the best position to have a leg up in the marketplace whenever we went there, right? But for whatever reason, we don't keep that same energy when it comes down to investing. So for most people, they go and invest into the thing before they invest into themselves, right? And so some things just really work in parallel in life. And that journey to investing in ourselves, to put ourselves in a better position for a better job, we need to keep that same energy as it pertains to going out investing in the marketplace, because, scripture says that a fool and their money shall soon depart. And so we have to be careful that however we obtained this liquidity, right, and we got proficient at something to make this money and have the excess, that we're good stewards over that by going to make the proper investment in ourselves to understand what investment vehicle should we be investing in and how should we better invest this $50,000 before we essentially light it on fire.
Yeah, I agree, which is why I haven't done it. Right? Like, that's exactly why I stay in my lane, where I'm like, you know what? I know how to put this in a mutual fund. I know what stocks I can pick, and I know how to leverage my unique insight in technology and the future of trends in tech to make smart investments. But I don't know how to make smart investments in real estate. So if I'm like, all right, cool, I'm definitely going to do this $50K and I want to take this as an opportunity to learn. So how would I approach it then?
Yeah. So, and just so everybody know, I'm not trying to sell y'all nothing, right? Morgan brought me here to be open and honest and transparent with y'all about how I've been successful, right? And I'm giving y'all the blueprint.
Yeah.
So the first thing is,
you can
in
also
my
tell
opinion,
people things. I don't care. That's fine.
Yeah. I mean, but I just want people to know, like, I'm not, because you know how it is. It's like everybody got a narrative, everybody got an agenda. Like, my agenda is to give you guys everything that you need to go out and make the informed decision on going out and investing in real estate, right? And I just believe that the education piece is paramount, whether you do it with me or whomever you do it with, because otherwise you gambling, right? And we should risk our way to wealth, because otherwise we're gambling our way to poverty. There's only one or two things that we're doing. And so, I just think it's a fundamental piece. And so, first of all, finding people that align with you morally, ethically, and then have the success is the way I pick mentors, right? I think that's important, because I've had mentors in the past that had the financial success, but what you tune into, you turn into. It's very important that you have the people that you're around and you're gleaning from that, in my opinion, they should align with you morally and ethically, as well as have the success. So that's like the prerequisite for me. Short of that, I think it's really getting clear on, like, what's your life goals? Because I think depending on what your life goals are, is going to determine which real estate vehicle or strategy you should use to get there.
Mm-hmm.
Right. So if you're someone that's looking for retirement, in the next 24 months or 5 years, then you're probably going to want to build out a cash flow portfolio and buy rental properties, because that residual income could then supplement and or replace your current active income at work. Right. If you're someone who is looking to build chunks of money so that you can diversify and maybe put more money into the stock market, put more money into trucking companies or whatever that appetite is, then you may want to look at flipping and wholesaling, which are great chunk money strategies. So I think it really depends on the appetite of the person. What is it that they're trying to do over the next 12, 24 months, 5 years, and then kind of reverse engineer which strategy they should use to get there.
Yeah, I think that's smart. When you say wholesale, can you explain what that means?
Sure. So wholesaling in the simplest form, it's an A to B and a B to C. Okay. So A is the seller, right? So Morgan has this property. She's like, I want $200,000 for it. Okay. So then I come in and I say, I can't pay her 200, but I give her 170. Right. So Morgan and I agree to the 170, and then I go out into the marketplace and I find C, who's my buyer. Okay. And then I say, hey, I got this deal for 200,000. The ARV on it, the after repair value is 350. You probably could put 20 grand into it, make 60, 70 net on the flip. So they say, sign me up. So A was Morgan the seller, me was B as the wholesaler, and C was the buyer. So the 170 that I got the commitment between you and I with, then I in turn give it to somebody else for 200. The 30 grand I collect in the middle is the wholesale fee. That's wholesaling at its most simplest form.
That makes sense. That doesn't feel like a very passive approach. That's a real active deal maker.
For sure. It is.
Yeah. So that I would put that in the bucket of non-passive. That's an active, that's an activity. I'm like, put me on the other side.
I'm going to tell you the God honest truth. I'm going to tell you because we got to debunk this myth. The only passive strategy in real estate is this private investor, period. Cash flow is not passive. If you are passively managing your cash flow portfolio, you will soon not have any cash flow.
That's right.
As I sit here today in my office in Orlando, and I own 120 units 800 miles away in Detroit. Before this call, I was on a call with my property management company. We huddle every single week. Right now, granted, I'm putting 6 to 8 hours a month into my business at this point, right? Where we produce tens of thousands of dollars every month, but I'm still putting 6 to 8 hours, right? So it's not set it and forget it. You have to have solid infrastructure around you and keep your pulse on the operation at all times, because nobody ever cares as much as you do. The key is to be able to convey enough vision and have people buy into your vision that they care enough in your absence, but still nobody cares as much as you do. And so if you don't press the issue, they certainly won't.
Yeah, I completely agree with that. And I feel that way all the time. I'm the queen of finding random bugs on Blaudy's websites. Like, I can find bugs 10 times faster, like website bugs, faster than anybody else. Like, why? Because I'm the only one who cares that much about that random, ad that's supposed to show up and pop up to the left, and it's showing up and popping up to the right. Nobody else cares but me. You're right. So I think that's actually key, is like, if you're going to outsource and delegate, then you still have to be a manager and a steward of the resources. It's not like literally set it and forget it. There's some investment classes that you can do that, but the return on investment isn't going to be as significant as, being slightly more active. I think that's really critical. So one of the questions that I have for you is related to single family investments. Assuming somebody has their primary residence already, or they're renting and they're very comfortable in where they are, like, how should someone approach thinking about investing in a single family unit versus a multifamily unit straight out the gate?
Yeah, I think going back to where we started a little while ago about asset protection, I'm like you, right? When I go to the banks, oftentimes they're like, where's your debt? Like, where's your stuff? I'm like, what you mean, where's my stuff? You know what I mean? Like, should I go out and come back in and start this thing over? Like, I'm supposed to have debt? So I've got millions of dollars in loans and in debt that are in my entities that hold those properties, right? They're not personally on me. I have nothing on my DTI. And I believe that that's the way you should operate as a business owner. However, the least path of resistance to investing in single family could be, for many people, to just go out and use their name and sign on a dotted line and maybe put 3 to 5 or 10% down and acquire their first rental property that way. I think is how most Americans would do it. I teach that your investment should be in LLCs at minimum,
Mhm.
and that you want to keep your business and your personal separated.
Mhm.
And so, for everybody, I would say start where you stand. But if at all possible, I would recommend going out and buying your first income property in an LLC with an S Corp election and build out your portfolio that way.
Yeah, I think that's the right move too, just from a risk management perspective, particularly if this is
For
not your
sure.
full-time job. Like, a lot of people listening to this podcast are very successful in what they do. They might work at a big tech company. They might already have a business, like a couple retail shops or studios, like a bunch of hair studios, salons, whatever. So you got to protect what you've got. And I think I'm not always a fan of creating new LLCs, but I think in real estate, it does actually make sense. So, what's the minimum amount of cash that you've seen in your programs, people that you mentor, or for yourself that someone's been able to successfully acquire property that is accretive to their, net worth and their assets?
I think it's funny that you mentioned 50,000. I think 50K is a good benchmark number for
Mhm.
someone that's trying to get into their first property, because again, if you buy it in the LLC, more than likely you're going to be putting 20 or 25% down, right?
Yeah.
So I think 50 is a good enough number to where you can, acquire the property, get into it, do some minor maintenance if necessary, and then still have a little bit of cash reserves on hand. Because that's another
Mhm.
part. I know a lot of people think buying cash flow should be their first investment, right?
Mhm.
And I get the reason why they think that. However, if you aren't well capitalized and you go into this cash flow scenario, it could be investment suicide for you. If you're taking the bulk of your reserves and or all of it to put
Mhm.
down just to get in the property, well, what happens when, year one, you got an HVAC system that goes out and you got to spend 7 grand to replace it, but you were only collecting $200 a month net,
Yeah,
right? Well,
that's
that
right.
money got to come from somewhere. So, for some people who are illiquid starting out, I would highly recommend maybe do a flip on your first deal. Go build
Mm.
up 30, 40, $50,000 and then pivot and doing your first cash flow. That way you got some cash reserves on hand should things come up, as they always will.
Yeah, that's right. When you're considering a flip, like I just want to break that down a little bit further because I think, you're so good at what you do, people might miss it. Let me say it again. So you got 50K and it's possible that you go out and buy a $250,000 house, right? 20% down. But instead of doing that, we're suggesting don't do that because you're not really giving yourself much flexibility if something were to happen. So look for a $200,000 investment, right? So that's 40% down. That means you got 10K that you're sitting on that can be, put back in the market in a low interest thing or something just so you have it as a reserve. And when you buy that $200,000 house, instead of it being a house that you're going to then turn into a rental income, it's going to be a $200,000 house that you're going to maybe put a little bit of sweat equity into, maybe some, fixtures, some things that will get a better value, and you flip it. And if you flip it even for 200 and now you're selling it for 240, 245, 235, you have made a return on your investment.
That's right. That's right. Yeah. And I think even more to take that a step further, nobody has a money problem. They only have a knowledge problem.
I
And
agree
when I
with
say
that.
that, I mean, right. So, like, with the proper knowledge, believe it or not, well, when you think about it, right, 97% of millionaires have what in their portfolio?
They have real estate.
Real estate, right?
Yeah,
And the thing that's so interesting about that statistic is that only 10% of them are active investors. So there's
correct.
87% of millionaires out there who are not active investors that have real estate in their portfolio. So how does that happen? Well, they look for people to show up as experts that can
Hmm.
show them how they can deploy their capital with them, and then they can get a return on their investment in the absence of them having to do any work to get it. So
That's
when
right.
you understand that, there's far more people out there waiting for you to show up with the right knowledge as an expert that wants to partner with you, and they'll fund your entire deal. Like 80, 90% of the deals that my students do, they do with no money out of pocket.
Yeah.
So then that kills that limitation of how far can I go predicated on how much money I have, as
Right.
opposed to how far can I go based on the capacity that I have.
Right. Let's actually talk about that, Brian, because I get approached constantly to be the wealthy person whose balance sheet people use. And I've hesitated to say yes to those deals because when I get the spreadsheets, when I get the projections and I look at the returns, I say, I could actually beat this in the stock market. Like my portfolio in the stock market is doing better than these projected returns, which are not in fact guaranteed at all. Right. And although the stock market's not guaranteed at all either, there is a historical
Yeah.
like range that is very de-risked. So I guess like what is the scenario for someone who has the assets and balance sheets? We have a lot of millionaires who listen to this podcast or people who have,
Sure.
discretionary income. They don't have the time, time, but they have the
Yeah.
cash. So they might be on the other side of this equation. What are the things that someone should be considering or evaluating when they're approached with a deal? And is it the right mindset to be evaluating this, like the opportunity cost against something like the stock market?
Yeah, I think that's so wise, right? I think we always have to look at our opportunity costs as investors. At the very same time, a lot of my investors, especially in my apartments, they are like overcommitted in the stock market and they're looking to diversify
Yeah.
and have at least a slither of real estate, if not more, depending on how well that performs for them. So they understand that they are giving something up, right?
Mhm.
Comparatively speaking to the return that they're getting in the stock market. However, they're gaining a tax shelter that they didn't previously have from the stock market.
Mm.
So there is some added benefit with the depreciation and the write-offs that you get on the real
And
estate
that
side.
passes
And the
through
truth,
to the person who owns the equity.
100%,
This
100%,
is these
right?
are
So
the
deal
things that we
structure
need to
is
know,
paramount.
Brian. These are the
Deal
things.
structure is paramount,
Let's
right?
talk about
Because
it.
you can be an equity investor or you can be a rate and term investor. And by being an equity investor, then that means that you get to capture all of the things that happen through that property as an equity partner in that property. Right.
Mm.
So one of the key things to look out for as an investor such as yourself is finding out, are you an equity investor? And if so, are they planning on leaving you in for the duration of the investment? Some investors, I don't particularly do this, and I haven't historically,
Yeah.
is let's just say I'm buying an apartment building for $1 million and we're going to put, say, $1 million into it in renovations, right? And when we're done, this thing is going to be worth $3 million. These are
Mhm.
real numbers, by the way.
Yeah.
So I go and raise a $500,000 from two different investors. They give me $250,000 a piece.
Yep.
I reserve 50% of the deal for them as my limited partners, right?
Mhm.
And then I keep 50% of the deal as a general partner. And that's for me to take care of putting the deal together, running it, all the rest of it. When we get to a point where we've stabilized the project and we go to do a refinance and we pull out
You pay them
some of
back.
the initial, right, some in some cases, right, depending on where
Mhm.
rates are. Right now we're not pulling all the money out because it just doesn't make
Mm.
sense based
Mhm.
off of where rates are right now. However, most investors will refinance their partners out and then they're out of the picture. For me, I would much rather refinance them and keep them in the deal, and then we just go do more deals together,
Yeah.
right?
Well, that is actually the
So,
exact reason I've said no to every single deal, because every single one of the
okay,
deals has at the 5-year mark, we're either going to sell the property, quote unquote, or we're going to
yeah,
refinance and pay you all your money back. And I say,
yeah.
so then I'm just a glorified lender. Okay, pay
I
me in
mean,
equity.
when you put it that way, Morgan, I mean,
I'm just saying. And I'm like, well, I don't need to lend money. I don't need the money back because I want the big dollars on the back end.
yeah,
I can
yeah,
do the math. And so that's why I've always said no, or why I've always been so reluctant. What I know myself, if I'm procrastinating and I'm taking a long time to wire the funds, to sign the paperwork, to bring my legal team into it, I don't like the deal.
yeah,
Because I've had deals where
yeah,
people will be like, hey, I need 10K. I want to do this thing. I'm like, bet, money wired, send me the contract, like done.
yeah,
You know?
yeah.
Am I thinking about it wrong?
I think you're thinking about it right. Investing is so interesting because it's all predicated on appetite. And if
Mm,
your appetite is such that you want to be a real player all the way through, then the investor needs to appease your appetite,
mm,
or it's just not the right deal for you. Right. But I just think as an investor, what I will want. Right. So I put that out and reciprocate that in the marketplace. And so for me, it's like my desire will be, if I'm going to take the risk with you up front,
that's right.
then I want to stay in it long term, right? And take all the benefit throughout. And so that's what I do for my investors. And it's been a fruitful relationship by doing it that way. Now, at the very same time, have I, went and raised debt on a property, meaning,
Sure.
went and raised all private money,
Sure.
bought something cash, using their money, refinanced them out in 12 months? Absolutely. But guess
Yeah.
what? That was their appetite to do such a deal. So every
And that's
investor is
fair.
different. Some 100%. Some don't want to be in for a long haul. Some like, hey, if it's a 12-month horizon, I could get in and get out and make 8, 10, 12% on my money. They're good with that. So as everybody is thinking through this, the viewers, you got to first think about, like, what's your appetite? Do you want to be
Mhm.
a part of deals long term, or are you somebody that's just kind of want to put velocity on your money and move it in and out of another vehicle outside of stocks or wherever that it is that you currently participate? The other part that I found to be very beneficial is, like, for our students in our program, in
Mhm.
our mastermind, they lend money to one another. The benefit to that, though, is they're both learning the same thing. So it's a
Mhm.
lot easier to hold somebody accountable to what's right or wrong when you also understand what's right or wrong. I think that's also very key.
Yeah, that's right. I think the other part of what you said that's interesting is like, if someone is going to treat me as a lender, then I need my return to be more or less guaranteed. But if you're going to treat me like a lender and say, well, maybe this is what we'll get and maybe this is what we'll get and da 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 da, then it's even more risky, right? So then the deal doesn't seem to make sense. And I think when people are approaching investors and they're going to do the sweat equity, they're bringing the knowledge to the table, they're making the deal, you're literally just leveraging that person's balance sheet. Like they're not involved at all. You still
Hmm.
have to consider the alternative use of those funds for that investor and what they're considering
For
against it.
sure. For
It
sure.
can't just be, well, it's just 8% return. Okay, but if the market right now is doing 12%, then why would this person do this? This person got
Yeah.
wealthy for a reason. They know how to do math. Literally one deal. This is how bad it was, Brian. One deal. I had this. I was like, "Am I
Morgan,
tripping?
you crazy.
This doesn't make sense." I put the numbers in ChatGPT. I was like, "ChatGPT,
Oh
what am
Lord.
I missing? What am I missing? Why would I do this deal? Like, run it." And ChatGPT was like, based off of the averages of the returns on investment and what you could get in the market, you shouldn't do this deal. So I'm like, if ChatGPT can tell me it's a no for me
Mm,
too, then
mm,
run it.
mm.
If you're gonna,
But I'm gonna
that'd
tell
be
you
my
one of the
advice.
biggest problems.
Yeah.
One of the biggest problems, and you just alluded to it, is people who raise capital thinks that the spreadsheet raises the capital, but it doesn't. Conversations do.
Mm-mm. Mhm.
You need to get to know your investor. You need to understand where is their money right now performing or not performing. What's
Yeah,
their appetite? What's their desired outcome? You got some investors that want to invest to lose money, not to make any. They already make too much.
that's right.
Come on
Talk
now.
about it. Actually, break that down
So
for people. Why is that? Tell me what that use case is where somebody like me might wanna lose money.
because you're looking for more write-offs, not more income.
Yeah,
You're looking for ways to keep more of the money that you already are making, not to make more money, because that additional money don't change your life, but the write-offs help to further change your life if you can get enough of them, right?
while
And
maintaining an asset that is also appreciating, to be clear.
while maintaining an asset that's also appreciating. And the trifecta is when that asset that's also appreciating is also cash flowing with no
Let's
tax
go.
ramifications behind it.
This is
So when
chestnut
people say
checkers,
like Trump,
people.
1000%, when people say like Trump don't pay taxes, there's a reason for that. And it's all
100%.
legal, right? Like that's probably a messy topic right now, but I'm just saying, like it,
Well, maybe it wasn't legal, which is why he got convicted, so maybe not Donald Trump.
well,
Let's go like Bill Gates.
yeah, let's go Bill Gates then. Let's go Bill Gates, right?
Also a
But
problematic
what I'm
figure. Okay,
saying
maybe
is,
not Bill Gates. We need a non-problematic male billionaire. I don't know if that exists, but insert someone you all
mm,
think is not problematic.
yeah, yeah, y'all fill in the blank. But the point is, right? Like I have a CPA who happens to be a tax attorney,
Mhm.
and the goal is for us to make cash flow and not pay taxes on it. Period. And
Mhm.
so there's carry forward that you have every single year
Yep.
that should help to neutralize the money that you're making. So although you're making money, you're not making money, if that makes
Yeah, and you
sense.
can use those carry forwards for up to, I think, 5 years, depending on the business. That's why people also have to have
Yeah,
consistent
yeah,
LLCs.
yeah.
When
And
people ask me, and I've talked about this before in the podcast. I think I actually talked about this, you guys, if you're curious, on my income streams episode, where I talk about how I built my matcha business, and it doesn't make money. Like it makes money. It makes more money than like from a cash flow perspective. But I
yeah,
invested, I think, $70,000 plus to get it off the ground, which I'm going to be able to take that loss, split over a period of time. And that's
mhm,
okay for me because to me, I'm building up an asset in the matcha brand. If I ever want to put fuel on that fire and blow it up, I can. It's a diversified income stream for me. It's more or less passive. It's built, it's in the warehouse, you ship it, fulfill it, you move on. And that, I think sometimes people are looking at the internet and they're like, oh my gosh, this person like must be making so much money, or you're looking at the random convenience stores when you go into those random strip malls, and you're like, you might be asking, how is this company making money? Like, how does this exist? Maybe it's a loss because that person has diversified income in other places. So don't always look at every business and say, oh, I want to do that, thinking that that's spitting out a ton of income for someone, because you never know what actually is going on behind the scenes or why someone has that business.
for sure, for sure. Everybody's got a strategy based on their unique situation. And
Hmm.
so that's why it's incumbent upon any investor, real estate investor, to go and speak with the people in which they're trying to procure this money from to understand what's important to them. Because otherwise, see, a lot of problem I think in business is where we try to think for the marketplace instead of from the marketplace. And
Mm-hmm.
so we need to go and start to pick the brains of those people that we're trying to enter in business with, because the thing that may make us excited about the deal is not the thing that makes them excited. Now, it doesn't mean that both things don't exist in the deal, but if you're talking to them about the wrong part of it, then you're never going to raise the capital from them anyway.
That's
I.e.,
right.
that's what Morgan just told y'all. Just saying.
It is. I'm giving you guys the rubric, because I think what happens a lot of times is like for anyone who's raising money, and I raise money, right? Like
Mhm.
in the same way that people might approach me to invest in their deals, I raised $12 million plus for Blavity. And so I've approached other people for their deals to say yes to this. And the key thing, and I completely agree with you, Brian, the key thing that you have to ask yourself is, what is this person evaluating? What are their success criteria? Who are their investors? Who are their limited partners or
Mm,
LPs? And
mm,
what type of returns are they committing to their LPs? And once you understand the entire infrastructure in the system, that everybody serves somebody else, and there is someone at the top of the food chain, and it's probably not the person you're
mm,
talking to, it helps give you clarity in how you're going to pitch that person or that fund or that investor. It's so important when you're going out into the marketplace. It took me a long time to learn that, and I was incredibly frustrated along the way because I got a lot of no's. But frankly, I
yeah,
deserved those no's. I was
yeah,
presenting something that didn't make sense for the type of funds that I was going after. It wasn't
for
until I
sure.
really understood the right investor profile for what my personal goals were and the type of investor I needed in my business at Blavity that I started to get yeses, to the point where, we're oversubscribed. People try to give me money all the time. I don't want it,
Yeah,
you know,
yeah,
but it was a slight adjustment that had a huge impact.
yeah. No, that's major. I agree with everything you just shared. I'm really at a point now where I only take money from people that I like.
Yeah.
Whereas before, when you start, you take money from anybody that's willing to give it to you,
Yeah.
right? But now it's like, if I wouldn't sit over and have a cup of coffee with you, you probably not somebody I want to take money from, because
Probably
that
not the
money
right fit.
comes with a soul, right? And
Yes.
I can't have everybody in my space, right? I
No.
just can't. And so I agree with you. The investor does have a profile, and that profile is not indicative of how much cash they got. It's indicative of the character that they have.
Yeah, and to your point, like once you exchange money with someone, you're also being held accountable to being responsive to those people as well. And
Hmm.
I think that's really important. When my investors call me and they need something because they have to report out on their stuff, I don't mind giving it to them because I like them. If I
Yeah,
had a bunch of jerks
yeah,
on my cap table that I didn't like, then it would irk me every time they reach out, you know?
for sure,
And I
for
think,
sure.
for people who are listening to this who might have a wealthy network of folks and they're willing to put the sweat equity in, you still need to consider the type of investor that you're bringing into your business, because you want to make sure that it's somebody that you're going to be okay talking to for the next 5 years every quarter.
For sure. For sure. Some people stroke a check and think they own you.
That's right. 100%.
And
That's the worst.
everybody's temperament is different, but just in the brief interaction you and I have had, I think our temperament is probably very
Yeah.
similar in that regard to our intolerance for that type of behavior. You know what I
No,
mean?
I have
So
given people their money back.
yeah,
But like, you can
yeah.
have this 50K back. I don't want it. I'm out.
Yeah, yeah.
For real.
It's so funny. It's so funny when you do that to those people, because you can see how startled they are. It's
Yeah.
you knock the wind out of them completely, because they're just not accustomed to that.
Right.
And it's so liberating when you do it. And I just make a habit of avoiding those people at all costs now, to be
Yeah. You
honest.
gotta live and
I
you
just
learn,
if I can't raise the money from the right people, I just rather not do the deal, honestly.
Yeah, I think that's a privilege, though. I think a lot of people aren't at that point yet. I think at this point in your career, you're probably at that point, right? But in the beginning,
Hmm.
like you said, we hustling, taking the refund check, putting it back into the business, trying to flip it, and that's okay too. Like, everybody's on their own journey, and this no different than me being back in college, taking the books that these rich college kids left out because they didn't want to return the books to the bookstore and get the refund. I took all them books and put them things on Amazon and flipped it and check,
That part.
and got that margin, right? Everybody's in their own arbitrage. The question is just, how big is your arbitrage?
Mm, I like that. That's good.
That's how I
That's
feel.
good.
That's
Yeah,
how I
that's
feel for
good.
real. So, okay, back to my questions. I went on a rant.
Come
You
on with
guys
them.
like
Come
that.
on.
Okay, let's talk about like current trends and the economic climate. I think the thing on a lot of people's minds is the interest rates are very, very high. They're slightly
Hmm.
adjusting downwards, but I imagine a lot of people are sitting on a ton of inventory right now because the market is one in which people aren't moving houses as quickly. So,
Hmm.
how have you approached or changed your strategy, if at all, because of the interest rates and the trends happening right now?
I think for us, similar to what you just said, I think we've always played the arbitrage game. So rates never have been as big of a concern for me because I'm always looking to outperform whatever the rate is.
Mm-hmm.
So there's two different types of investors, maybe three. But one is those that buy cash flow exclusively for the reason of what it says, to cash flow,
Mm-hmm.
right? You have other investors that may be in challenge markets like California, New York, where the cost of real estate is so high that it's difficult to buy things that actually cash flow. So they buy for equity, that I'm gonna have a burn rate on this money every single month for
Mm-hmm.
X amount of years and hope that someday this equity is there so I could cash out and make my return. And then I think the third investor would be a hybrid of the two. And so I just, and again, I don't advise, well, yeah, I do. I advise that people buy cash flow for cash flow. I think the prerequisite for any cash flow deal is that it should cash flow. Okay.
Hmm.
Because I don't believe in buying a deal to literally burn through money every month.
Hmm.
Right. I think there's a better way to accomplish that because again, we buy deals that look like we don't make money, but we make money. So I don't believe fundamentally in that premise, but there are plenty of people that do. And so the biggest thing is making sure that you have enough margin on these deals that you're looking at. If you're
Hmm.
buying deals to where, you making less than 10% return cash on cash, right? So for instance, to put that in numbers, so let's just say I buy a deal for 200,000 and I got, 30 grand tied up into the deal. On that 30 grand that I have committed into the deal, not the loan, I want to make sure that with the cash flow that I'm collecting, that I'm making at least 10% on that money. Right
Right.
now, I don't want to freak people out. My minimum is more like 18, 20%.
Yeah.
But in the markets in which I invest in, I can achieve that. And that's my risk profile. I don't like playing too close to the edge because all it takes is one thing to happen. And then all of a sudden,
I
this thing
agree.
that you bought as a asset is now quickly a liability for you.
Hmm.
So I just recommend that people don't play too close to the edge. I think there's still enough opportunities in the marketplace with healthy margins that you can outperform wherever rates are. Sometimes we buy deals because I like buying deals that are empty more often than not in my market versus that have tenants in them. Just
Hmm.
because after the rent moratorium in my particular market, it was taking 6 to 8 months to get people out. So I'm like,
Yeah.
we could buy them day one, do a value add, and put our people in day one.
Yeah. You never want to
And in
kick people out
doing
of their
that,
house. That sucks.
yeah, right. So we do that, and we have, say we start with asset based loans that may be at 10%,
Hmm.
right? As we go through our approach of stabilizing these assets, before we even do the refi, our deals cash flow even with the 10% rates.
Oh,
You know
interesting.
what I mean? So I'm doing that
Hmm.
as I'm giving that as an example to show people that even with higher rates, if you buy right and you buy below the market, that there's still enough meat on the bone to where you can cash flow with higher interest rates. There's no
Yeah.
reason not to buy deals that don't cash flow, in my opinion.
Yeah, I mean, I think that that's just not finding the right deals. I mean, I'd imagine that the reason people will wind up in those situations is because they are potentially trying to buy in the city they live in.
Yep.
And the place that you live in may not need to be the place that your tenants live in. Okay. So,
Man,
like I said, I
yes,
live in
man.
Nashville. And my partner Josh and I, when we were thinking about going the real estate route, we were looking at Huntsville in Alabama. And I remember looking at some places, and these were multifamily, like I think like 5 to 10 door units. And I was like, I don't know about this. And I had to remind myself, just because you wouldn't live there, that doesn't matter. Like, this is not, you're not picking a place to live, Morgan. You're picking a place that, has the right economics, is safe. You want to be proud of the whatever real estate that you have, but you can change cosmetic things, right? To make this make sense. But I'm curious what advice you have for folks who are managing a property remotely. And is that a consideration that you take in consideration when you're looking at deals?
Yeah, so now you speaking my love language, Morgan. So our whole premise, our whole approach to real estate is remote investing. Okay.
Hmm.
And this is how we've been able to help people in Denmark, Japan, Afghanistan, all throughout the states, because it is a unique strategy. Now, I will preface this by saying remote investing, although I practice it 800 miles away from where I live, is really more so the way in which you set up your infrastructure. So going back to earlier in the conversation where I mentioned with the right infrastructure, you can put in 10 to 12 hours a week into your business and grow a multiple 6-figure, even 7-figure business. It's because part of the remote investing is the most important component is having a project manager. Okay. And that project manager is going to be the person that you delegate all the day-to-day activity to so that you can focus on the two highest and best skills that I previously referenced, which is analyzing more deals and raising capital. If you can do those two things and you got somebody else doing the day to day, then now all of a sudden you just freed yourself up to grow something pretty substantial. And
Mm-hmm.
the whole reason why I believe in remote investing is because I was also a 9 to 5er, right? I was in corporate America as an operations manager for a plastics company. I left there at 35, and I wouldn't have been
Mm-hmm.
able to retire from work that early on had I not been able to invest remotely and put more velocity on scaling my business. I live here in Orlando where the market is all kind of messed up because
Yeah.
of the attraction and the draw in this area,
Right.
right? People do things that are just fundamentally irresponsible as it pertains to buying properties. So as an investor, it becomes challenging to make deals that make sense. So my primary market is
Mm-hmm.
in the Midwest where there's a ton of opportunity, great equity and cash flow positions. And so I just found that to be consistent with our students that live in Cali, for instance, that invest in Atlanta or that invest in the Carolinas.
Right.
It's always good. I mean, we become entrepreneurs to have what? More options, right?
Yeah.
So why would I limit myself in the vein of investing by relegating myself to only my marketplace when if I have the right fundamentals in place, then I could use this infrastructure and put it in any marketplace where I have more opportunity and more options to then
Right.
scale myself to financial freedom,
Yeah.
And so the infrastructure is everything. And I try to preach to people that the proximity is not what protects you in a transaction. It's the process that protects you.
Mm-hmm.
If you fundamentally don't have your business set up the right way, I don't care that property is 8 houses away from you. If you get a contractor 50% down per their request and you don't know that they got a drug problem and buy prostitutes on the weekend, as many of them I've come in encounter with do, and you give them 30,000 down on a $60,000 job, guess what? They not
Yeah.
answering your call no more. And you can
It's
drive past that
gone.
house every single day and it's
Mhm.
over, right?
It's
So it's
gone.
not the proximity of the property, it's the process in which you go about investing in the property. And so, paying your contractors in arrears is paramount. Pay them based on
Mm.
work completed. When you start with an employer,
Yeah.
do they give you money in advance of doing your job? No, more
No.
more more often than not, they have you work a week in a hole. So pay them based on work completed. But how do you counteract that when your money is real, the deal is closed, you're scared, you don't know what's going to happen, you're at their behest? If you aren't the expert and you don't know how to even articulate why you should pay them in arrears, then you're going to acquiesce and do it their way. And if you do it their way, you lose almost every time.
Every
So,
time.
I know I digress, but I lost a lot of money
No, I
dealing with
completely agree
contractors
with
at
you.
one point, and the result of it have gotten a lot of clarity and insight in this area. And this is
Yeah.
the most exposed area that every investor goes into because you need them to execute the deal. I don't care how good the numbers look on paper, how excited you are about it. If they can't execute and you can't properly hold them accountable to execute, you're going to lose every single time.
Yeah, your team is critical. I mean, we have a course that should be launching soon, potentially by the time this episode comes out. So you guys can check my website if it's available, but it's called Master Your Team. And it's about that. Exactly. It's like, how do you put the right people in place? Because no matter before you can focus on revenue and growth, before you can like really scale up and buy back all your time, if you don't have the right people in place, then it doesn't matter because you're going to make the initial investment and you're going to have a leaky pipeline, right? It's just like, you can have a crazy top of funnel in any sales world that you have. You've got amazing, if you're an online business, you have amazing email open rates, amazing engagement on social media. But the moment somebody goes to convert with you, if the link is broken and the system doesn't follow up, then it doesn't matter. It doesn't matter how good your deals are at the top of the funnel. It doesn't matter how good the math is, like Brian is saying, and the projections and the amazing returns you're going to have. If the moment that deal is finished, you drop the ball because you don't have the right team in place, and whatever business you're in, honestly, you're not going to be able to scale and you're going to wind up actually losing money, frankly. That's what I see happen more often than not, is that people lose twice. They lose time because they got to redo stuff, right? Like it's messed up. So you lose time instead of gaining your time back. And then you lose money because not only did you have to lose whatever happened, you have to fix whatever was broken. And that oftentimes is more expensive. So it's honestly easier to have your game plan and your team in place, frankly, before. And I don't always say that. Sometimes I'm like, just do it, just launch, just go. But not exactly when it comes to team. I really do think that it's important to at least have your game plan, your job descriptions ready, your pipeline of candidates ready so that when it's go time, you're not wasting money.
Absolutely. I mean, human capital is the most important capital. And we
Mhm.
can't win without good teams and infrastructure. I tell people all the time that if it's not worth doing it the right way the first time, it definitely won't be worth doing over. So let's take
Mhm.
the time up front, do the proper due diligence, set the right infrastructure in place. And the truth is, though, going back to being an expert, people have to first identify with you as the expert and somebody that they should be listening to, so that you can really build and
Mhm.
galvanize a team and cast your vision and have people buy into and subscribe to it.
Yeah, I agree. So, Brian, I could keep going. I think that maybe we'll have you back on the podcast. Let's see, people, if you guys want Brian to come back, let me know. Write in the DMs, write in the comments, questions you have for Brian. But, Brian, where can people find more information from you? How can they sign up to be one of your mentees and learn more about the world of remote real estate investing?
Sure, they can find me at Brian Adamson Official on all platforms. If you come through Instagram, I'd love for you to shoot me a DM. I am in my DMs, like I love to talk to you guys. And then I want to give everybody a free gift since I'm here. We've been talking about remote investing. If you guys go to www.iflipebook.com, I'm gonna give you guys a free copy of my Investing Remotely ebook. And it's meaty, like you can take it, contextualize it, and actually go out and apply it. It's no fluff. And I hope that you guys use it and do something productive with it.
Perfect. And I'll make sure that's in the show notes, you guys, as well. So you can head to the website, or if you're listening to this on Spotify or iTunes podcast, you can go ahead and see in the show notes. And while you're there, make sure you leave me a review. I've been loving the reviews lately. I appreciate you all so much. You guys know I've been asking you this every week for the last 52 weeks. Okay. And you're finally hearing me. I very much appreciate you leaving a review with whatever you learned from that episode. If you really liked this guest, it's so helpful for me, and it helps other people find this podcast organically in search. So thank you for doing that. All right, Brian, this has been so fun. Thank you for coming to the Journey podcast.
Yeah. Thank you for having me.
Thanks for listening to the Journey podcast. If you enjoyed this episode, make sure you leave a review and head to our Instagram and YouTube to leave a comment. I look forward to hearing how this podcast has made an impact on your own journey.